Right now, Nuburu Inc., ticker BURU, is trading live at 27.68 cents per share, which is down sharply on the session, falling 2.44 cents, or 8.10% for the day. And that single intraday data point tells you almost nothing about what is actually happening here. The immediate expectation for anyone looking at this name is that you're evaluating a high-tech speculative play on blue laser technology. You're probably thinking about its applications in welding copper for electric vehicle batteries, maybe for a company like Tesla stock, or its potential in advanced 3D printing. The story's supposed to be about photons, precision, and manufacturing efficiency. But the reality is that this is no longer just a laser company. In fact, you could argue it's barely a laser company at all right now. The stock's chaotic, volatile movement swinging between 12 cents and nearly $1 in the last year is not a reflection of laser sales. It's the signature of a company in the midst of a frantic and complex corporate reinvention, a pivot so aggressive it's almost unrecognizable. What you're actually looking at is a defense tech roll-up strategy, funded entirely by massive ongoing shareholder dilution, and it's one of the most complex and high-risk stories trading on the market today. The common belief, the one that probably got this stock on your watch list, is that Nuburu's patented blue laser technology is a superior tool for processing metals that are highly reflective to traditional infrared lasers. We're talking copper, aluminum, and gold. This advantage should, in theory, place it perfectly to benefit from the electrification of everything: EVs, battery manufacturing, consumer electronics, and all the high-tech components that go into devices from a company like Apple stock. That expectation is logical. The problem is that thesis has completely failed to generate revenue. The hard numbers are staggering. In its most recent available financials, Nuburu reported quarterly revenue of just over $9,000. Not $9 million, $9,000. The cost of that revenue was over $800,000, leading to a gross profit margin that is a negative 8,000%. The net profit margin is a negative 400,000%. These are numbers that signal a complete and total failure of the original business model. The company has a going concern warning in its filings, which is the accounting world's polite way of saying they are on the brink of insolvency and may not survive. So when you see a press release from Nuburu, you'd expect it to be about a new laser contract. Instead, the reality is a barrage of news about acquisitions, strategic alliances, and most importantly, financing. The real story of Nuburu is not its technology, it's its transformation plan. This plan, led by its executive chairman, involves pivoting the company entirely away from being a simple component supplier and attempting to build a unified defense tech platform. This isn't a small shift, this is a tear-down-to-the-studs rebuild. The company you thought was making lasers is now focused on drones, special mission vehicles, and mission-critical software. To do this, it's not developing the tech itself, it's buying it. It's trying to become a microcap holding company. This entire strategy began in earnest this year, and the news has been relentless. In October, Nuburu announced a strategic alliance with Maddox Defense to form a new joint venture focused on military and commercial drone systems. This JV is targeting, and this is a management projection, around $100 million in annual revenue by 2028. Just days before that, the company announced it was acquiring Orbit SRL, an Italian software firm specializing in operational resilience and crisis management. This is where the story gets even more complex and, for many investors, deeply concerning. This isn't a straightforward acquisition. The SEC filings revealed that Orbit SRL is wholly owned by Alessandro Zamboni, who also happens to be Nuburu's own executive chairman and co-CEO. This is a related party transaction, a move that is always a significant red flag for corporate governance. The company is, in effect, using its funds, or rather the funds it's raising, to buy an asset from its own chairman. The deal involves an initial 10.7% stake with a plan to acquire the rest. This move is part of a much larger European defense tech acquisitions, including a planned acquisition of Tecne SAPA, another Italian firm. Nuburu's management is painting a picture of a future where these pieces, lasers, software, and drones, all fit together into a synergistic defense powerhouse. The company just announced on November 6th that it was strengthening its balance sheet to advance this defense tech acquisition program, and that it anticipates initial billings of around $500,000 in the fourth quarter of 2025. That's a start, but it's a drop in the ocean compared to the cash it's burning. This brings us to the most critical part of the analysis, the part that every trader on Interactive Brokers or Robinhood needs to understand. How is Nuburu paying for all of this? With virtually no revenue and just over $100,000 in cash as of its last full report, it's not using profits. It's funding this entire transformation by printing and selling stock. This is the source of the extreme volatility and the crushing downward pressure on the share price. In July 25th, shareholders approved a shocking proposal to increase the number of authorized shares of common stock from 250 million to 900 million. They also approved a reverse stock price, a tool companies use to artificially boost their stock price, usually to regain compliance with the stock exchange. In fact, Nuburu received a warning letter from the NYSE American in mid-October for non-compliance, precisely because its stock price had fallen too low for too long. It only just regained compliance. Alongside these moves, the company has been executing public offerings, including a $12 million offering in September, and is using a standby equity purchase agreement, or SEPA, to draw down cash as needed by selling shares. This is the central tension for the stock. The expectation is a high-growth tech company. The reality is a distressed shell company executing a highly complex, high-risk roll-up strategy funded by diluting its retail investor base. The institutional ownership in the stock is practically non-existent, sitting at less than 1%. This means the big, sophisticated managers at places like Fidelity or those running Schwab Intelligent portfolios are not involved. There are no Fidelity mutual funds building a position here. This is a purely speculative vehicle, driven by press releases and the hope that this new defense tech strategy isn't just a desperate gamble. The stock's daily swings are not about market fundamentals, they are about capital raises. When the stock pops, it's often a sign the company has secured more funding or is in a position to sell more shares. When it dumps, it's often the weight of that new supply hitting the market. For an investor using a platform like SoFi Invest for self-investing, this is an exceptionally dangerous name. It's not an investment in the traditional sense, like buying NVIDIA stock for its data center dominance or Apple stock for its ecosystem. This is a speculation on a financial maneuver. So what is the original company, the blue laser part, actually doing? Nuburu's technology is, by most accounts, interesting. Its high-power blue lasers are genuinely better at welding conductive metals than infrared lasers, which tend to reflect. This spatter-free welding is highly desirable for making the bus bars, foils, and terminals inside BIA batteries. Better welds mean better conductivity and battery performance. The technology also has applications in 3D printing copper, a notoriously difficult material to work with. This was the story the company told when it went public, but that story has been relegated to a single business unit that is now being revamped. The November 6th press release mentions a plan to acquire a different blue laser business to fold into their own, one that supposedly comes with engineers, R&D facilities, and a customer base. This is a tacit admission that their own in-house efforts to commercialize the technology have failed. They are now trying to buy what they couldn't build, all while juggling the acquisitions of software and drone companies. Looking forward, the future of Nuburu Inc. is almost impossible to forecast using traditional metrics. There are no earnings to model, no PE ratio to debate. The entire value proposition rests on two things: the market's belief in Alessandro Zamboni's vision of a defense tech conglomerate, and the company's ability to continue funding its operations by selling its own stock without the price collapsing to zero. The bull case, if one can be made, is that this is a turnaround play. If management successfully acquires and integrates these new businesses, and if those businesses like Orbit and the Maddox JV actually hit their lofty revenue projections of $19 million and $100 million respectively, then today's $35 million market cap will look absurdly cheap. In this scenario, the company uses the public shell of BURU to build a real revenue-generating enterprise. The bulls are betting that the extreme dilution today will be worth it for a much larger piece of a much bigger pie tomorrow. It's a high-stakes bet that might appeal to a certain type of trader using a Robinhood stock trading account, someone looking for a lottery ticket. The bear case, which is frankly much stronger and better supported by the evidence, is that this is a going concern for a reason. The company is a financial black hole.